This is Michael Fox, and this is the Prospector News Podcast. And joining with me again, longtime friend, analyst, and contributor, Chris Temple of the National Investor. Welcome, Chris.
Hey, Mike, good to be with you again.
Yes, good to have you. So we're a day removed from the latest Fed meeting. I have to say I was surprised. I was expecting another 50-point jump, and they surprised me with that 25-point move.
Well, they wouldn't have shocked me had they done 50 basis points either. The problem going into the meeting, though, is that a couple of Fed heads had already run their mouth and said, oh, we can probably do 25. So that was the only number that was out there. And the Fed has a habit, right or wrong, these days of not wanting to surprise the market. So they did that. So plan B, therefore, was that the Fed would lower the pace of rate hikes to 25 basis points, but would still stay pretty steadfastly hawkish. And on that subject, Jerome Powell wavered a fair bit, certainly enough to get a lot of the bulls on Wall Street to double down on their view that they simply do not believe the Fed is going to follow through over the balance of 2023 with what they've said. So, Powell, in the language, the Fed said additional hikes are still likely appropriate, not hike. They didn't say they were going to stop after this one. But he threw it, in my opinion, for a Fed chairman who should have and probably needed to reiterate the resolve that they have to make sure that this inflation is bottled back up, which, look, I don't think they're going to do it in the end anyway. That's a corollary discussion. But, looking at the headlines and what most of the shallower thinking is on both sides, I guess, which is regrettably what people operate with, he needed to come out and push back against the market's behavior in January and say, basically say, and I'm paraphrasing, of course, that, look, you're not getting the message, folks. We are going to take interest rates up another couple times or so. We are going to keep them at that high level, at least through the end of this year. No, we are not concerned, about the possibility of a minor recession. So what does he do instead yesterday is when he was asked bluntly about, and this is the key phrase everybody has used, Mike, financial conditions. Financial conditions in the markets are not reflective of a Fed that has gone to, by their definition, a restrictive stance and wants to get more restrictive still and stay there. When you look at the yields on junk bonds, they're little changed the last 300 basis points of Fed hikes that we've had. You look at Treasury yields, they're completely out of whack with where the Fed is and where they say they're going. So he needed to do that, and instead, he capitulated to the markets, in my view, and basically said, hey, yeah, I see that the markets, are pricing in things several months down the road. Maybe we don't see, but hey, that's how they see it. And, we can agree to disagree. And that just wasn't enough. Now, look, I still think we're going to continue to see more of a slowdown in the economy. The Fed will get enough to hang its hat on to pause maybe after one or at most two more rate hikes. But, look, there's still a lot of liquidity out there. There's still a preponderance, if not a majority of investors that still behave as if this last year was an aberration and that the Fed really is about to imminently get us back to 2% inflation, helped by a slowdown in the economy, and this is all going to go away. And it's probably going to take a lot longer than some of us thought, maybe than I thought, for this epiphany to hit the markets, that we're going to stay with stagflation. Inflation is not coming back down to 2% for a host of reasons. And, but it's going to take, I think, maybe more months for that to sink in than what we thought. And Powell didn't help that yesterday a lot either by talking out of both sides of his mouth. He moronically used the term disinflation, which is going to come back in some months or a year or so from now and bite him in the rear end, just like using transitory did for so long when he was talking about prices going up for a period of time. So, he gave the Pollyannas on Wall Street too much rope, and they ran with it.
I wouldn't disagree. I look at things and I'm seeing energy, like the price of oil has been going up and up here for the last several weeks. And with China reopening, the demand for oil there that's been kind of held back is going to start to flow again. And I'm looking at it going, in the next 45, 60 to 90 days, I think we're going to see an increase in the inflation rate again because energy prices are going to start to push it up. I'm
You're right.
seeing headlines that say don't expect your food bills to go down anytime soon. So if food inflation is still up, I personally I can't see where the Fed can back down anytime soon. And to be honest, if those factors are still, and I'm asking this as an open question, but if those factors are correct and we start to see inflation moving upwards again, is a 50 basis point hike back on the table again for the next round?
That would be a stretch. That would really jolt the markets. I think the Fed would be afraid to do that, having come back down to 25 yesterday. And with, admittedly as well, signs of an economic contraction growing. I mean, look at the ISM numbers. Half of the Federal Reserve districts have been telling the world that their district is in some modest contraction. None of this is a disaster yet, and it still may not be because there's still a lot of liquidity out there. Credit conditions, as I pointed out a few minutes ago, are still fairly easy, even if people have to pay up a little bit more than they did a year ago. So, despite all that, I don't think the Fed would do that. I think maybe they would by May. If we are seeing inflation tick back up, they would signal that, okay, maybe we're going to do one or two more 25 basis point hikes. But 50 would show that they made another major error, that they're scared, and it would really spook the markets if that were to happen. So I have to wonder, and I heard somebody years ago that came up with a pretty clever saying that I think is got a lot of truth to it, and that the Fed, you hear some of the stuff that comes out of Powell's mouth, and before him, even that dim-witted bag lady, Janet Yellen, when she would give her press conferences and stuff. And yeah, it seems like these people are stupid, but maybe they're sometimes a bit smarter than we give them credit for, even me. And they look at us as lab rats, Mike. If I say this, what's the reaction going to be? Okay, so they say stuff that they hope is going to lead to a certain outcome. It might and it might not. And, Powell has put so much out there. I mean, yesterday was the proverbial exercise of throwing a big plate of spaghetti against the wall to see how much of it sticks. And so whether you want to take a dovish view or a hawkish view on what the Fed said, there was something there for you. I don't think he should have done that, but that's what he did do. So I think in the end, he realizes that they are going to be correct. I think in the end, he realizes that the markets are wrong, but he's got to be, treat them gingerly. I put out something on Twitter yesterday reminding people what happened when the markets rebelled against Powell at the end of 2018, when he acted like he was going to continue raising interest rates, and they threw a fit and he was forced to run up the white flag and reverse course. It's not going to come as easy this time, but he doesn't want to get to that point in the first place. So I think he's willing to continue to talk and act like, when they pause, he'll talk more about disinflation. He'll talk about things are going the right direction, but we got to be absolutely sure. And they'll stay there. And I think that as inflation does stay elevated, the markets will finally get it, maybe in fits and starts rather than in one sudden way. The markets will reprice themselves over the balance of the year to where they probably should be now and where the Fed would rather they were now.
Well, how much of this rhetoric is to try and create that soft landing that the Fed is trying to attempt here? Markets look like they're trying to price in a soft landing, but every time we've had these scenarios where we've gone from a superheated economy and we've tried to create a soft landing, it's failed pretty miserably, and we've hit pretty hard.
It has, but let's distinguish what we're dealing with today with what episodes were like that you've described and that we all lived through over, let's say, the last 40 years. Over the last 40 years, when you had inflation bubble up, it was usually because of only the Fed got a little bit too easy and they overdid it. So now they got to overdo it on the way down. Maybe they caused a mild recession. When you remove the shocks from the boom in tech stocks and then that crash starting in 2000, you look at 2008, which was a financial event and stuff like that. Those things happen with financial excesses, but not with this impractical built-in inflation that has come to visit us again after a 40+ year absence, that goes way beyond just how much the Fed exacerbated it by printing money. You've got supply chain things still across the board with commodities. You've got one after the other, underinvestment for years, underproduction for years, policy decisions on the parts of governments that have made things worse in most cases. And so across the board, and you mentioned energy, I mean, there's no way oil should be $75 a barrel right now. And I would tell you that at some point before this year is over, we will be back in triple digits again, unless we have a big global bust. And then, of course, that'll be delayed. So this situation right now of the people thinking we're going to have a soft landing and all the rest of this stuff is being debated in an environment, and I've got to come back to this, that the markets still don't get. They think it's going to be really easy to put this inflation back in a bottle and get us back to the 2% area so the Fed is our friend again. It's not going to work that way. And, I think that the longer the markets, and I'm going to read something to you. I forget who I copied this from this morning. So whoever it is, I apologize, because sometimes I'm doing my morning lap around social media and emails and stuff. And here's how one guy who gave a really good assessment. I actually retweeted it. So if you go to my Twitter feed, it's there. He says, in a nutshell, and this is after going everything Powell said, right, wrong, or different yesterday. He said, in a nutshell, the longer the market doubts the Fed's resolve and the higher it rallies in response, the bigger correction that is likely to ensue, should indeed the market eventually come to realize that the Fed isn't going to blink soon, that its hawkish policy is increasing the odds of a deeper recession and a systemic crisis that will result in a lower bear market bottom than we saw in 2022. Now, I don't necessarily think we're going to have a systemic crisis right away. The Japanese bond market continues to flash a big yellow warning signal. However, that's a wholly different subject. But I do think, as I said a few minutes ago, that as the year goes on, it's going to start to sink into the markets that even as some of the economic numbers weaken further, tomorrow morning, of course, we don't know it yet, it'd be a big number with the January employment report. But what if we've seen the best that we're going to see of these declines of inflation? The last couple of readings we saw some benefit of goods prices coming down, retailers, haberdashers, clothing and some of the things like that. There was a glut of those things in the last year. But as Powell also pointed out when he was talking out of that side of his mouth yesterday, services inflation is still as high as it's been. Real estate is still too hot. Okay. The employment figures are still showing a lot of strength. So we'll see. I think this is going to continue to be a slow, dull ache. I thought that yesterday the Fed was going to fire a shot across the bow of the bulls and that would be a turning point for this rally. I was wrong, at least through this morning.
Yeah, well, if it was a shot across the bow, it was with a pellet gun and not with a howitzer.
Yeah, super soaker or something like that.
Yeah. So with all this said, there's got to be opportunities in 2023 moving forward that people should, be looking, because we're in a changing environment and pivots are going to occur.
Oh, no question. And at some point, and we don't know if it's after one or two more rate hikes yet, or none if we were to see a collapse in the economic numbers between now and their next meeting, and mid to latter part of March. But I think that the new fangs theme that I've talked so much about, and as you know, I'll be giving the keynote address as the Minds and Money Conference opens in Miami in a few weeks, and talking about this very thing. There's a host of factors that have come together that are going to continue to elevate commodities generally. We have started the process, which people have waited for years, for commodities, and again, I use the word generally, to outperform financial assets. And so I think that almost no matter what happens this year, we'll see repeats of what we did even in 2022. If you were in conventional energy in 2022, you made good money in a bear market generally for stocks. If you were in uranium stocks, you did well. If you were in some of the better stories among battery metal stocks, you did well. Gold and silver outperformed the stocks in those areas. But I think that with their run so far this year, which I'm a little bit queasy on right now, I actually told people yesterday to sell our trading position that's a leveraged gold bullion ETF. We made some good money on it, just like we did on the silver one we sold recently. But I said, hey, if I'm wrong, we still got lots of individual stocks that will ride up, and we are. So, long term, I think that all of these commodities, some are going to do better than others, but all of them are going to go up for all of the same reasons. Too little supply, growing demand. Uranium and nuclear energy is still a marquee story that probably is, aside from conventional energy, the single best story you can get onto, because they're, at least, unlike with some of the battery metals and mining and the pushback on mining and the idiocy, at least in our country still, of how the Biden administration is not really helping things a whole lot. Uranium is one that everybody has gotten behind.
Yeah, I was just at conferences in Vancouver, and uranium was a big participant in all of them.
Oh, I would think so.
Definitely. So, we're going to have lots of stuff to talk about going into the future. If people want to get in touch with you, Chris, where will they do so?
Just go to nationalinvestor.com. If you sign up, if you're not already on our list, if you sign up for our free newsletter list, what you will receive will be a recent issue I did on the precious metals in just the next few days. I'll also be sending out my latest special issue on the whole new fangs theme. That will also include several of my current recommendations. And then immediately following that will be one dedicated solely to uranium and nuclear energy, because again, I think of all of the new fangs themes, that is the one worldwide that even people who until recently were opposed to nuclear power, that the light bulb has finally gone off over some people's heads and over some policymakers' heads, that there is not a single better way to reduce carbon emissions and still have reliable 24/7 power than with nuclear energy. And look, when you have the world's most notable climate scold, that little young lady from over in I forget which country, Greta Thunberg. Is she in Sweden, Mike?
I think she's Norwegian, to be honest.
Or wait, where? One of those Northern European countries.
It's one of those Scandinavian countries.
Right. So when the biggest climate scold, little Miss Greta, embraces nuclear energy, you know that everybody is on board. And she's done that. It's a story that I'm happy to say is long overdue. It makes all the sense in the world. The only emission that you have from nuclear energy is steam. And when you look at most of the recovery in the world of uranium, it has the smallest footprint. You're not digging these big strip mines to try and get lithium. You're not having big open pits in the earth to get copper and nickel or whatever. The majority of the production in the world is ISR mining, where you're just sticking a pipe in the ground. I'm oversimplifying it, but to make the point.
For those listeners that are in the Florida area, you can actually join Chris and I both at Mines and Money in Miami coming up at the end of February on the 23rd and 24th. If you come to my website, theprospectornews.com, find the Mines and Money link and register. If you use the code TPN, the initials for the Prospector News and the number 10 right after it, you can save 10% off your admission badge. So good extra value for you. You get an opportunity to hear some key speakers and meet with companies head to head. Thanks, Chris, and we'll be talking again in the coming weeks.
Well, and we'll have to tip back a few brewskis or some kind of libation in 3 weeks from. Actually, we'll be getting down there 3 weeks from yesterday, Wednesday.
Yeah, it'll be it's coming up really rapidly. So yeah, I'm looking forward to it. It'll actually be my first time in Miami, so new place, new experience.
Nice. That'll be fun. And I guarantee you the weather's going to be warmer than it is up there.
Definitely. We're heading for minus 40 wind chills on Friday night. I'm so not looking forward to that.
Yikes.
I'm wishing I was down with you.
I'll bet. All right. Well, you take care. I'll see you soon.
You bet. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.